Hello everyone, welcome back to my channel. So this video marks the beginning of week number 20 in this Road to 200k challenge, and there's a lot of to unpack here, many things to talk about, but the most important thing that we have to speak today is the fact that we managed to get rid finally of our holdings of Estée Lauder. As you can see here, we managed to sell them at a price of $82, which was above our average price, and so we managed to get our capital back. And actually it was quite a sweet profit because those were 3,300 shares, and if we use the selling price minus our average price, yeah, it ended up being quite a sweet profit. Almost 5k, and so yeah, this was actually very good. I'm happy with this. It was a better outcome than I expected. So now what we have to do is close up, input this trade here on the scoreboard, and there's a lot of calculations going on here. I'm not going to do those on screen because it takes too much work. We need to also determine how much in premiums we received to be able to estimate what is the total profit on this position. And so yeah, we'll do this later on, but for now, the things that are also important, we managed to use most of this cash as a collateral to sell 3 contracts on the QQQ. For those who are not aware who the QQQ is the ETF for the Nasdaq index, because now it seems clear that selling puts on stocks, it's a much riskier proposition, and of course it's more profitable because the premiums are higher, but you get an additional exposure to risk, because if the puts are assigned because the stock came down, you are forced to buy the shares, and if the price continues to drop further away from your acquisition price, then you are forced to do basically what we had to do with Estée Lauder, is trying to buy at lower prices to bring the average price lower and further down, and as a result you end up committing a lot of your funds in the position, waiting for the position to recover. And so this is not optimal for our strategy, because as you saw, for quite a lot of time we could not do anything. We could not sell calls, try to sell the holdings back. And then with an index, because indexes are less volatile, and usually they do not divert too far away from the current position because, of course, the lower volatility. It's much more convenient for us to pursue this strategy, because at the end of the day, the wheel strategy benefits when, or it's most appropriate for stocks and securities that don't move or move very little in terms of their price. And so, yeah, that's why we decided to sell 3 contracts on the QQQ, in the ETF for the Nasdaq, and this is just for one day, because you have available on the option chain. You have options for the day we do the trade, for the next day, for 2 days after, 3 days after, 4 days after, and then you have for every single business day you have an option. And so it's good. We basically used the options that expire today at the same day. So what we are going to do is basically making a trade every day, and by doing so we benefit from what we already spoke about in a previous video on why the wheel strategy is profitable in the long run, because of the options Greek, the theta. And to give you a very brief reminder of what is the theta is the change in the option value, the change in the value of the option due to the passage of time. And we also know that the theta is negative because it's decreasing all the time due to the passage of time. But we know that when it comes to the time of maturity, let's just say the maturity is right here, the maturity drops very, very fast. The theta drops very, very fast. And so what happens is that by selling options that expire on the same day, if the price of the index remains mostly the same, the option value will drop very, very fast, because by selling options that expire on the same day, what's going to happen is that you are only exposed to the theta at this location. And so the more the theta drops, the more you win, because the theta is negative. So by being negative, it benefits the seller of the option. And so the seller of the option, that's what we are. And so we, even if nothing else happens, we benefit just by the theta dropping very, very fast as the option is very near to maturity, because it expires on the same day. So basically that's what we did. We sold 3 contracts with a strike price of 523. At this point, the put is already in the money, because the index is coming down today. However, I don't think it will be a very big of a deal, because then tomorrow we can do simply the opposite trade, which is basically selling an option, selling a call instead of a put, which would be right here, this one. And because the index does not move much, we should be able to, the vast majority of the time, sell the option at the sell calls at the acquisition price as a strike without too much trouble. So it will not be necessary for us to just keep buying more and more index shares to lower the average price, so that then we can try to sell the whole lot. So this is the plan for the time being. And also another thing we need to consider is that because of all the collateral that was released, because we sold the shares of Estée Lauder, we managed also to sell some puts on 4 with a strike price of 10.5. As you recall, our strike price is our acquisition price plus the loss on the call that we had was 13.36. All right, so we are now selling a put with a strike price of 10.50, and so if we manage to buy these, the average price will go to around 12. So next time we'll be able to sell possibly calls on 12 and still breaking even, which is exactly what we want. And just to give a brief example here, if we pull up the option chain for 4, we can see that for 1 week is not yet available, the call for $12 of strike, but here it is already. It's a meager premium, but that's what we need to do in order to be able to try to get rid of the shares of 4. Now, another thing that we also did is sold puts on Pfizer, because now the goal is to basically get rid of all the shares that we have. The acquisition price is 28.50, and we also sold 4 contracts to buy 400 more shares at 25.50. And if we manage to do that, our average price will go down to 27, and this makes it easier for us to then get rid of the stock. It's a good quality stock, no doubt. I'm still very much confident that it's a very good stock, but if we have an option that will expose us to less risk, we might as well do that and not think too much about it. So as you can see here, with the call strike price of 27. Here it's available for 1 week, and it's a reasonable premium. So this is what we are shooting for, but of course the price has to come down to 25.50, which is unlikely by the current market implied probability. But this is what we can do for now, and if the prices drop further, we might as well also consider buying directly the shares and then try to sell at a later stage, at the same way we did the Estée Lauder. But for the time being, this is it. Let's just input the trades of these puts on our scoreboard. I will do later the selling of the Estée Lauder shares, and then I will share all the calculations with you in the next video, because I think that's the most reasonable way for us to do this, in order not to bother too much with calculations, which of course are important for us to keep track, but are a little bit boring for you, and all the followers to see that. So these puts will expire on the 13th of December, right? So it is. And now this is for Ford Motor Company. This is a cash covered put, strike price for 10.50. These are 4 contracts, and we managed to get a premium out of this, which was 5 cents, and we paid $3.99 for the fees. So this is it, $3.99. all right, now we can copy this here, put Pfizer cash covered put 25.50. These are also 4 contracts, and I think we managed to get a little bit more out of this. 6 cents is not that much. That tells also that the puts are relatively out of the money at this point, but yeah, that's the way it is. And so basically we have also these commissions to pay. So $2.93 plus 98 cents is $3.91. So we'll have to do this, $3.91. All right, and so this is it for now, and we'll have to see what's going to happen. Now, another important thing also to keep in mind is that we also have to input here our trade for the QQQ, all right? So because this is a normal trade for us, right? And this is it, QQQ. It's a cash covered put. Strike price was 5.73. These were 3 contracts, and the premium was 31 cents, if I am not mistaken. 31 cents, and we paid 2.06. All right, so it was 2.06. Good. So this is it for now. And in the next video I will come back with all the calculations for you all to see. Just to give you also another notice, I will post another video at some time, if not in the next week, then the week after, and I'm going to explain all the mistakes that I did that led to this situation in which we accumulated a lot of shares of Estée Lauder. I have a pretty good idea of what went wrong looking back, and so I want to share this with you, because if you try to do the same and trade options in order to make money, because that's what we are all doing in here, you might as well be aware of all these potential pitfalls that can happen to you. But for the time being, this is it. Feel free to like the video and subscribe to the channel. You can also leave your comments in the comment and questions in the section down below. And I'm also available on LinkedIn and through the messenger to answer any questions or share any insights that you may want to. So this is it, and we'll reconvene at the end of the week to see how the trades went. I'll see you there.